I can't keep getting away with this, seriously. I sold down my BIS at the end of last month for a couple of reasons. The first reason is because I felt like it had become close to fully valued, being up more than 20% from where I bought it. The second reason is that a whole bunch of people on Hot Copper were bandying about speculations about BIS getting a big government contract to supply hull steel for Australia's new submarines, and Hot Copper being excited about something is widely regarded as a strong bearish indicator. So about a week later, when the price had risen even further to $2.58, I sold the rest of my holding. This was right before a large special dividend, and after I sold, the price kept creeping higher even after the special dividend. So as the month was starting to draw to a close, the people who hadn't sold when I did were not only sitting on a higher share price, but had pocketed a 16-cent special dividend on top of that. And I was getting ready to write a script about how I was second-guessing my sale and maybe I should have let it run a bit longer. At this point, I'd missed out on another 12% gain since my sale, and I was feeling pretty silly. But then, it fell off a cliff. I don't know whether to call this luck or risk management. I mean, obviously there was a bit of both. The whole point of valuing the companies you own is so you can sell them down if they stray too far above that valuation, and that's exactly what I did here. So maybe I should take a little bit of credit for this. To be totally real with you though, when I sell a company, I'm not doing it because I'm expecting it to instantly shit the bed. The fact I owned it in the first place means I thought it was a good company, so I'm only selling because I think it's running out of upside. Running out of upside is very different to immediately shitting the bed. So the fact that my only 2 sales of the year have immediately shit the bed afterwards is not expected behavior at all, and it makes me really glad that most of my sales were already documented in a video before the bed shitting happened, or else people would think I'm faking my trades. Incidentally, to minimize the amount of market movement that can happen during the editing phase, I've started closing data on the last Friday of each month and editing over the weekend, so that there's less market movements able to happen while I'm editing. Obviously, you have no way to know that I'm really telling the truth about any of this stuff, but at the very least, even if I hadn't done a single trade and just held the initial portfolio for 5 months, I would still be outperforming the market. So if thinking I'm lying about all my trades makes the videos easier to digest, then feel free to think that, honestly. My initial plan was to pump the capital from the BIS sale into TWD. But TWD just kept flying higher and higher and is now up 18% from my acquisition price. Plus it went ex-dividend, so there's also a 7.5% dividend gain, which has been realized but isn't on the charts because the money hasn't finished transferring yet. So TWD is currently at a 25% year-to-date gain. My biggest regret here is failing to put more money into this bet. There was an entire week where my investment thesis had been vindicated by the unaudited quarterly results, and the share price hadn't moved. If I had been using my brain at all, I should have spent that entire week buying more and more TWD. Instead, I only bought one more parcel of $5,000, which is obviously better than nothing, but I still feel like I fucked up by not holding at least twice as much of this share as I currently do for the run-up it's had. I'm not at all afraid of this pick shitting the bed, and I plan to hold this for a minimum of another 8 months to realize the capital gains tax discount and await for further share price appreciation. What has been shitting the bed is the old portfolio, which makes me really glad I sold most of my Allchem a while back. Most of the new portfolio gains have been actually wiped out by losses in the old portfolio. I say losses with big air quotes because at the end of the day, the old portfolio still has a 3-digit green number next to it, so it's not really a loss, it's just gain reduction, but whatever you call it, the numbers over there are getting smaller and I don't like it. Despite all my outperformance in the new portfolio, my actual wealth hasn't really changed this year, as new portfolio gains have been largely offset by old portfolio losses, which actually feels pretty shitty, to be honest. I guess that's just the price I pay for continuing to hold those high volatility stocks. They go up fast, and they go down fast. So when they have a bad couple of months, it can really be a kick in the balls. But they can also turn around just as quickly. My opinion of the picks hasn't changed, so I'm mostly just trying to ignore the fluctuations on the expectation that they'll come good again sometime in the next 12 months. Anyway, I can't just sit on the cash from the BIS sale. Once again, I found myself in the situation where none of my new portfolio picks were down, so I had nowhere to add the money without getting overcapitalized. So I went looking for another ticker, but this time I used a new value screen that I'd never tried. These were the conditions. 1. They had to be decently large companies. I set a minimum market cap of $1 billion. Usually I don't give a shit about market cap at all, but with Allcam in the shitter, I'm thinking of opening a lot of short puts, and if I want extra margin collateral for a play like that, I've got to buy big companies. Big enough to make the haircut list. The haircut list is just like a list of companies the ASX considers liquid enough to be acceptable collateral for margin transactions, so if you want to open a lot of short puts, this is something that you need to look at. 2. I wanted companies that had positive EPS growth over the last few years. 3. I wanted companies who had experienced a price decline over the last 1 year. And 4. I wanted companies with a good PE ratio. Essentially, I wanted to find a growing, profitable, decently large company that the market had fallen out of love with for long enough to make it into a contrarian value play. After looking through a couple of the options, I came across ORA, or Aurora, which is a company that specializes in packaging and complementary services like design and printing. Since they're diversified across all the major packaging types, glass, aluminium, plus the various types of plant fiber like paper and cardboard, betting on Aurora is not a bet on anything specific. This is the kind of company that is mostly going to grow or contract based on the fortunes of the broader economy. But they had shown an ability to consistently outpace GDP growth and had a good PE multiple. So that just leaves the question, why had they fallen out of favor with the market? The answer ended up being pretty simple. Essentially, they'd made a ballsy all-cash acquisition and had to do huge capital raising to fund it. Capital raisings are always a nightmare for the share price, at least in the short term, with the price usually dropping to and hovering around the offer price for long periods of time. But this one was doubly bad because the underwriters were left with a big chunk of the newly issued shares because it was just such a massive capital raising. And the underwriters aren't really interested in holding these shares long term, so any shares they're left with essentially just get sold into the market over the following months, even at a loss, which can keep the share price depressed for a long time, as long as it takes for them to finish this process. After a little research, I determined that the base company checked all my boxes, but that still left one big question unanswered. What about the acquisition? I can be pretty skeptical about mergers and acquisitions, especially if the acquisition broadens the scope of the company unnecessarily. I like my companies kept as simple as possible. It makes them easier to value and easier to manage. Was this acquisition really going to pay off in the long run for shareholders, even after all that price destruction? Well, honestly, I think it very much could. The raising was to acquire a company called Saverglass, which manufactures fancy glass bottles, overwhelmingly for spirits. But the main key factors are that they are, in their own right, a profitable growing company with connections in overseas markets that Aurora is trying to penetrate, as well as a high level of expertise in premium decorative glass. This acquisition checks all the major boxes. They've bought a quality company at a decent price, and acquired a lot of talent specific to their business model while staying laser focused on their primary business, packaging. They claim the acquisition will increase the earnings per share by mid-single digits, e.g. approximately 5% in the first full year after ownership, which, if combined with their business's decently high rate of organic growth, should make for a very good first year. This isn't one of those companies where I've got a price target right off the bat. This one in particular, I'm hoping to see the first couple of earnings before I decide on a future course of action, but in lieu of any information about business performance since the completion of the acquisition, I would have to say I'd like to see it get to close to $3 before I start to seriously consider reducing my holdings. If the first year's earnings are particularly good, that number could go as high as $4. You may notice that I'm valuing this company at a higher PE multiple than a lot of my other holdings. After all, BIS was trading at a pretty similar PE multiple when I sold it. There's two main reasons for this. One, this company has demonstrated a history of sustainable growth, whereas BIS was more a beneficiary of specific tailwinds that may no longer be around in 5 years' time. And two, because ORA is a big company of several $1 billion market cap. I'm pricing in what I like to call the normie premium. This is a phenomenon where people pay more for big companies, which I theorize is because normies consider large companies to be innately safer investments. It's also possibly due to the existence of people like me who are willing to pay a little bit extra for investments that are on the haircut list. Anywho, that's the month, and now we're headed into December. The market can get pretty quiet around the holiday period, so I may not post a portfolio update next month, but I've got a video about bonds that'll probably come around when the portfolio update would, so keep an eye out for that instead. Later!